For you, what is macro, guys? Level of what? Finance? Okay, so macro for you is more about an industry or an asset class, and micro is more like companies or specific, as you say, niche, for example. Okay. So macro equal the environment in which capital moves. Micro, analyzing a company. So in our case, we want to understand what is the current market about. Is it going well? Is it healthy? Is it not? Through 4 pillars. We're going to see that just in a bit. Macro, it's understanding the environment in which it operates, in which the capital flow. You don't fight the tide, you position with it. The tide in French is la marée. You don't fight the ocean when it's coming because it's the ocean. It's too big. So you just want to position with it. You want to adapt yourself. It's like, you know, when you are kids, you build a castle on the sand and then the ocean is coming up. You know you are dead. You are not going to fight, so you just move your castle. It's the same thing. You want to position yourself. Why macro matters? It matters because liquidity drives valuations, policy drives liquidity, geopolitics drives resources, and technology drives structural winners. There is 4 macro pillars. The first one is what we can call the monetary policy, interest rates, money supply, credit conditions, central bank balance sheet. Who knows what is a central bank?
Exactly? I know, but
Okay, a bit, not sure. Who can say? Who can try to say what is a central bank?
I can try, but in English it would be a bit complicated. A central bank is the bank who made the
Interest rate?
the interest rate and just print the money.
Okay. And how do they inject it in the system?
They give to other banks.
Yes, they give it to other banks, exactly.
They give the toll to the other banks and just
To lend or to borrow? Okay. Anyone want to add something? No? What is money supply? Total money in the market, yes. What do we call in economy or in finance the money supply? It's called M2. Just M and 2. It's the total money in USD. Credit conditions, it means what are the interest rates right now and is there a lot of lenders or borrowers. Central bank's balance sheet, it means what are the current balance sheet, basically. So as you can understand, what does it mean? Okay, it's written. High rates. When the rates are high, let's say you want to borrow money at 5%, we can say that the rates are high, which make the capital expensive, which make a pressure on growth. Because if money is not cheap, then it will be harder to grow. Low rates. It's easy speculation because, again, money is free, so people are just getting more and more money, and it's easy to make it. Do you know in the US what is the current Fed rate? Approximation, 3 to 4?
Yeah.
Who would say more? 3%?
Yeah.
Okay.
1
to 2%, okay. Okay. So, as you can see, this is the Fed rate. Source is from tradingeconomics.com. It's like the real one. And so, as you can see, it's going down with the COVID and then up and now down. And at the moment, it's 3.75. It's between 3.5 to 3.75 right now. Let's say it's 3.75. And it has a huge impact. And as you can understand, the market and the trading funds and every investors are selling or buying according to what the Fed is going to decide. Are they going to do a rate cut or are they going to increase the rate? That's very important because, again, if we increase the rate, the money is what? Is cheap or expensive? If we increase the rate.
more expensive.
It's more expensive. And now it's getting less expensive, which means it's easier or at least it's more interesting to get a loan, to borrow money to the bank. And this has a big impact on the current market economy. Then the second one is geopolitics. US-China tension, Ukraine war, Middle East instability, hashtag Iran-USA. Defense spending rises. Maybe you've seen in the US in 2026, in Canada as well, they are increasing their spending in the defense sector, which means some stocks can go up just because we understood that the narrative at the moment is based on energy, AI, and defense. But we are going to talk about that in a bit. So at the end, instability will directly involve energy importance, supply chain reshaping, strategic resource accumulation. In unstable times, physical assets matter more because it's more scarce.
Like gold.
Yeah, exactly, like gold. Geopolitics. If a war breaks out between the US and Iran. Okay, I made the slide 2 days ago. What?
What to do now?
Whoa! You're an insider, huh?
Yeah, but insiders, guys. So if, according to you guys, if a war breaks out between the US and Iran, what moves first? The market, yeah, indeed. What? Sector? Okay. Yeah, good one. So as you say, oil spikes, because they are a big producer of oil, energy volatility, defense spending rises, supply chain disrupted, commodities reprice. I don't know if you have seen an article, I think it was yesterday or 2 days ago, about how Iran is at least making $1 billion per year with Bitcoin. Anyone saw the article? It's because, yeah, exactly. It's due to that. And as you maybe know, like there is always blackout, like 1, 2, 3 hours per day in Iran. It's just because the, let's say, government, which is the party, the current regime, is using all the electricity to just mine Bitcoin. And that's how they make money. That's a big part of how they fund their regime, their organization. And that's why there can be energy volatility. And imagine if now then they cannot mine Bitcoin. Because if there is a war, there is instability in the electric traffic, in the electric network. And for Bitcoin to be able to mine, for the GPU, they need stable electricity. If it's not constant, the algorithm will not follow. It's very important to understand that as well. And then commodities reprice, because again, in uncertain time, it has a tendency to go up. War is not just political, it is inflationary. So things can go up. Third one, regulation and policy. For example, it can be AI regulation coming, industrial subsidies. Do you know what is an industrial subsidies? Yeah, exactly. It's government, in French, it's like subvention, which means like government helping companies, so they are going to give them credits or specific kind of help or bonuses or advantages. Tariffs and reshoring. Do you understand reshoring, guys? Tariffs, do you understand? I guess, yeah. Yes. Tariff, okay, les frais de douane in French. And reshoring? Reshoring, anyone? Reshoring is when, for example, you create like all your iPhones in China and then you want to start the production in US. So you want to get back the production in your own country. That's what we call reshoring. Energy security focus. What does it mean, energy security? Energy security is, let's say, kind of like an area now in the energy, which is you want stable price and clean energy. For example, in the US, with all the data centers, energy is costing more and more for the normal people, the Americans, and it's not good for them because energy is not clean, but especially the price is going up. And so the US at the moment, their main focus is energy security, which means energy price security, price stability for the Americans. Governments indirectly choose sectors, indirectly, okay? They choose the sector of energy, which means it's going to impact, for example, solar panels. It's going to impact electricity, energy company. So for example, defense budgets rising, then the defense companies benefit from them. Can be same for chip subsidies. Semiconductors supported, which means the government is going to give credits to every company that are going to buy chips. Very important. Here is one case that is interesting. So now I think it drops a bit. Now it's at $6. It did minus 15% from the news yesterday, but that's why I'm showing it to you as well. Regulation creates winners. This is TE. So this is what we call a ticker. Okay, with a dollar sign is the ticker, which is the symbol of the stock. On here, the knees. What does it mean, knees here?
New York Stock Exchange.
Yeah, exactly. So here, as you can see, US subsidized. So US is going to give credits. As you can see here, 3 February 2025, Trump latest tariffs raises duty on Chinese solar panels product to 60%. So he raised the tariff of the Chinese solar product. At the same time, US subsidies US companies to support the domestic energy. And at the end, you can see here, T1 Energy completes first tax credit sale, value at $160 million. And as you can see here, it's here. And then it's here. So it appeared like started the news here. And then as you can see, 31 of December, it's here. And why the news is 31 of December? Because people, they knew already what was coming. So that's why the stock price from here. It's not only about this news, but you understand what I mean. And that all the psychology of the market. People and the price of a stock is based on what? Psychology of the investors. So if there is a big news coming and people, they are waiting for it and they kind of know it, they are going to price the market. So your goal as an investor, later we're going to see that, is to invest in thesis, in specific stocks or companies or sectors that are undervalued on the market, which means not many investors are focusing on it. So T1 Energy, if I make it quick, tariffs, Chinese competitors are more expensive, so US domestic players gain pricing power, which means there is more people buying in the US, which means revenue improves, which means margins expand. Because the more you produce at scale, the cheaper it is for you to manufacture, and the higher margin you are going to make, which means the stock we just saw before is going to rise. That's it. It's very simple. It's basic economy. But if you understand that, you know and you understand why you invest in a stock. Because I'm not investing in a stock, oh yeah, it's going up, it's like making 50% Fibonacci, it's like trading a structure, and then it's going to go up. No, I can do that, which is called trading from analyzing. And we have to use the fundamentals, which is, in our case, the macro standpoint. Then, pillar number 4, technological shift. AI acceleration, automation, electrification, energy demand explosion. Tech doesn't just create apps. It creates infrastructure demand. AI growth equal more compute, more data center, more energy, more infrastructure. Let me show you an example with Iren. Anyone know the stock Iren? No one. A bit, Paul. I think Bilal as well a bit. Originally, it was a Bitcoin mining company. Now, they're pivoting into an AI data center because they have existing energy infrastructure. They already used to mine Bitcoin, existing data center, AI demand exploding. They just made the shift from Bitcoin mining company to AI data center. Now, before investing, I want you to ask yourself these 5 questions. Where is liquidity flowing? Where does the money go? Is it going into the defense sector? Is it going to which one? Then, what sectors receive structural capital? It can be investment from specific funds, from specific governments, from specific retail investors, because there is a war, there is something. Then, what is politically supported? Important as well, because again, politics is what influences the world. What is physically constrained? Is it an issue like physical issue, for example, with AI? Yes, it's infrastructure. It's electrification, electricity. It's power. It's resources. It's copper as well. What can AI destroy? vs. what can't it destroy? And if we just make the answer, where is liquidity flowing? You need to be selective, not euphoric. What sector receives structural capital? AI infrastructure, defense, energy, politically supported, domestic production, if you're in the US, for example, and energy security with energy security focus, as we mentioned just earlier. What is physically constrained? Copper, silver, electricity. And what AI can destroy? Repetitive services, as you know, agencies. And what AI cannot destroy? Energy, metals, infrastructure. What is for you guys infrastructure? What is infrastructure? If I'm telling you, guys, you should invest in infrastructure for AI. What is it? What? Yeah, but what is an infrastructure? Building? Yes? What is it? Can be what? Yeah. Can be bridges? Can be solar panels? Can be AI data center? Like all the infrastructure needed. Like same for roads. It's very important for you to understand that. Bonus. Now we can connect the 4 pillars. Example 2026. High rates. Right now we have high rates, but it's getting lower. We were at 4.5%, now it's 3.75. Maybe it's going to go down at 3.5%, which will make the money cheaper, less expensive, I would say. Geopolitical instability. We are seeing with Iran vs US, for example, or even specific economical war with especially tariffs. Industrial policies. I don't know if you saw, but for example, in China, from the 1st January 2026, they restricted the export of silver. China want to keep the most silver for them. And that's not for no reason, because they want to keep it to take, let's say, to have a leverage against all the countries and AI infrastructure demand again. So if you want to favor right now in the current macroeconomy, you want to favor energy, defense, metals, and infrastructure. You don't want to try to invest in an AI wrapper because it's just a wrapper. You can invest in an AI company such as Anthropic or others, but even that, they need energy, they need metals, they need infrastructure. Defense is another sector. Now, before finishing this, I want to talk about the AI feedback loop. I think Josias told me read the article from C. Trini Research. Does anyone else have read the article I sent in Insiders group? It was yesterday, 2 days ago. I know it was the long one, so I make a quick recap. So here, as you can see, when there is a recession, construction slow down, destocking, then lower rates, because you want more money to make the economy grow again. So you lower the rate, which encourage new construction, recovery phase, and then overbuilding inventory overshoot, which make construction slow down. So it's always going up, going down, and that's the goal of the Fed. For example, the central bank in the US, for the US dollar. Their goal is to have an inflation around 2%, because for them, it's the sweet spot. So that's why they put the rate higher or lower, in order to control the inflation. In COVID, they printed a lot of money because they needed money. Then they say, there's too much money. Then they higher the rate. We saw from 0 to almost 5%. And now they are slowing it down a bit because they saw the economy needs to continue to grow again. So they are making money cheaper. So once you understand that, you understand how the money cycle works, the debt, the credit. But this is a traditional cycle recession. Now, with an AI-driven economic feedback loop, we can have this one. AI investment increases and AI capability improves, which conduct to companies need fewer workers, which make white-collar layoffs increase. What is a white-collar, guys? Yeah, all the guys that have literally white shirts when they go to work, exactly. Can be consultant. Displaced workers spend less, which means people who are getting fired are spending less. Then the economy is going to weaken, to be weaker. Then the companies now, they are investing more into AI to protect their margins because an employee is costing more than AI, and which make AI investment increase again. And then it's a feedback loop. And as we saw not long ago, it's happening right now and it's going to continue to happen. I'm going to show you a clear example just after. So the great replacement. Take workforce to gig economy flow. As we have seen, mass layoff and reduction, labor flooding, which means there is so much high qualified people into low jobs, unemployment, transitional state, and then everyone is going to be into a low barrier, low entry job. So everyone, white collar, let's say, that we are doing, again, it's not going to happen soon, like within 1 year, you know, but if someone was doing 150K per year, maybe he's going to do 50K because he's going to do like a job that AI for now is not going to replace. AI for now is replacing white collar because AI is learning how to code, how to make research. And step by step, there will be humanoids that are going to replace the maids, that are going to replace the private chefs. But for now, we need some physical people. And white collar and other people, they are doing into the digital. That's why it's interesting to understand that. And if we see the last example, which was literally, guys, yesterday, Jack. Who knows who is Jack? Okay, who is Jack? Yeah, exactly. So Jack made Twitter, he sold it. After all, you know, like as a Black Hat guys, Blue Sky, he made Blue Sky. A lot of people use Blue Sky, and then Blue Sky was down, but anyway. And so one of his companies is Blocks. And Blocks on the New York Stock Exchange. And as we can see in this message, we are reducing our organization by nearly half from over 10,000 people to just under 6,000 employees because they are going to be replaced by AI. And what we have seen just after, it's the stock going from $55 to $75, which means it's the first step. It's a first step in what? Into what? Yeah, but it's an indication as well that when you show to the world you lay off, you are rewarded. You can say, yes, if I lay off, it will be a bad news because people they will think we go bankrupt. But now, this guy made this announcement, and then, boom, stock spike. $8 or $10 billion valuation within one announcement. Yes, Elvis?
What the company does, block.
Providing a payment system or others. So yeah, as you can see, it's important because it's literally happening in live. We are talking about Iran, US, it's happened literally, like I put it on the slide 2 days ago, it's happened like today. We are talking about AI disruption, it's happening yesterday. And so everything is moving very, very fast and faster than you can expect and than you can think. So that's why you have to position yourself, whether it's for your businesses, whether it's for your investments, whether it's for your life and your mindset and your vision, into what's coming next. Because I'm seeing so many people, they are just adapting themselves. It's good to adapt yourself in the current situation. But if you really want to create wealth and to grow your capital, you don't want only to adapt. You want to position yourself for what's coming. And that's what is important. Do you have any questions on the macro or micro standpoint? Yes, Josias?
The cycle, and usually it's like a rhythm, like every 7 years or 10 years, I don't remember. Do you think we can time this to anticipate the cycle?
I think we can time it as like Ray Dalio is showing in his book and stuff and other big financial guys. But with AI, it's hard to know exactly where we are going. With all the layoffs, for example, then with all the infrastructure issues, and then AI is replacing so many jobs, so many companies. So it's hard because there is money that is leaving specific industries and moving into new ones. And so it's not going to be called a recession, it's going to call a bankrupt sector. It's going to be the end of specific sectors. So I think we can predict that about sector, but if there is a market crash, it's hard to say. But it's not smelling good. That's why it's important to stay a bit liquid, to have cash aside. But I'm going to explain and to show you my life portfolio later. The thing we can be sure of right now is like AI is trendy, and it's going to continue to be trendy, but the bottleneck are not the same now than it was 3 years ago. 3 years ago, it was like chips, like how to get more AI compute, how to get this. Now it's more like electricity. Everyone is using AI. Like who is using AI daily, I would say? ChatGPT, let's say, or whatever. Everyone is using AI, you see? And the thing is, at the moment, all the models, they are saying yes, they are doing like huge improvements. But at the end of the day, they are not only making huge improvements, they are just increasing the computing, let's say, workforce. So instead of burning 200K tokens, they are going to burn 1 million tokens. So you think, yes, AI is better, but no. It's just because they are burning more energy, more resources. That's part of why it's evolving fast. Because if Claude, which is Anthropic company, is going to evolve, then OpenAI, so ChatGPT, doesn't want to be behind, you know? Otherwise, they are going to lose market shares and to lose value. So what they always want to go up and be the first. And to be the first, sometimes they just have to use the money they have, burn it, and scale it. And what do we want to do as an investor? We want to follow the money. We want to be in the middle. OpenAI do a deal with, I don't know, like NVIDIA, we want to be in the middle and cut the money. I mean, it's hard, but you got my point. Like, you want really to make money out of that. And I'm going to show you how to in the next slide.